Chief Economist for America's Credit Unions. In this month's video, I'll give you a quick line of sight into our newly minted economic and credit union forecast. Our forecast group, which consists of 8 current and former credit union industry economists, met on Friday, July 12th. We discussed the economy and the trajectory and implications for credit union operations and financial results. The biggest takeaway from this effort, I think, is that our outlook hasn't changed all that much. The most important key takeaway from our consensus outlook is that it continues to reflect the idea that the Federal Reserve will deliver on its promise of a soft landing. When asked to put the odds on the possibility of recession over the forecast horizon, our forecasters, on average, say that there's only about a 33% chance of economic downturn, a contraction in gross domestic product, over the forecast horizon, which now goes out to the end of 2025. A view that's been, as you can see, pretty consistent over the past 5 quarters. Transitioning to the macroeconomic outlook, it focuses on the Federal Reserve's performance in its quest, its mandate, to grow the economy consistent with full employment while controlling inflation. We do think that that is happening. Overall economic growth is declining a bit, but remains relatively healthy. That's good news. The declines that we're seeing overall in growth represent and reflect what we see in the job market, with more unemployment and access to fewer new jobs out there. So households are seeing that, and they're becoming a little bit more cautious, less likely to spend, less likely to borrow, and that will continue to show up in the GDP data. The slowdown in spending, which is related to the increase in unemployment, will be reflected in prices. So the inflation rate should come down, not strongly, and perhaps not to where the Fed really wants it to be, 2%, a little bit above that. But overall, that's good news. We'll be very close to that Fed target by the end of our forecast horizon. The real challenge in the household sector, I think, will be that while the inflation rate will be coming down, prices overall will remain quite high. How will all of this influence credit union growth? In a slowing economy with more unemployment, more people will be focused on building up rainy day funds and maybe seeking the safety of insured deposits. We think that most rate chasers are done chasing rates, and with lower interest rates, the difference between credit union yields and money market mutual fund yields will compress. That should be helpful. We already know that credit unions are paying up for deposits. That's producing strong savings growth and stronger than we originally forecast. So we've adjusted for that in this forecast. Loan growth, in contrast, we think is going to be a little bit weaker than originally anticipated. And the reason for that is twofold. One, we're seeing much weaker growth in automobile lending than we originally anticipated. That's about 30% of credit union loans overall, and much weaker growth in home sales and mortgage lending than originally anticipated. First mortgages represent about 40% of credit union loans. So that lower loan growth overall is a reflection, again, of a slowing in the job market. And even though rates will be coming down in this forecast horizon, the demand for loans we don't think will pick up very strongly given the uncertainty and the anxiety in the household sector. So what does this mean for membership growth? Membership growth will be relatively weak compared to our previous forecast. Membership growth, by and large, is driven by indirect automobile lending. And with lower growth in automobile lending, we naturally see lower growth in memberships overall. Asset growth will slow to a certain extent, but really it is a reflection of what's happening with savings balances. The big takeaway on our asset growth assumption is that the need for borrowing will be a bit lower, and therefore the difference between savings and asset growth will change a little bit over the forecast horizon. But generally speaking, those two metrics move in tandem. So I described a situation where savings growth is outpacing loan growth. And again, not just in 2024, but into 2025. That is a change from our original forecast, and it shows up in liquidity data. Here we have loan-to-share ratios. We now have loan-to-share ratios, rather than staying quite high over the forecast horizon, actually coming down in a perhaps not dramatic fashion, but coming down in a very helpful way for most credit unions. That should provide some of the relief that credit unions that were loaned out have been looking for. So these trends will be supportive in that regard. On the other hand, we do see more and continued stress in credit quality. And both delinquencies and net charge-offs have come up pretty dramatically over the last couple of years. Worth mentioning that they've come up off of near all-time lows. So in the case of delinquencies, we're back to long-run normal levels of delinquencies. Net charge-off rates are a bit higher than the long-run norm, but more than likely, there will be continued concern over asset quality over the forecast horizon and again, this is against the backdrop of a labor market that reflects higher unemployment and more disruption, and therefore a greater likelihood of missing those loan payments. And then finally, from an earnings perspective, we do expect earnings to be a little bit higher than in the previous forecast. We're now forecasting ROA of 60 basis points, about 10 basis points lower than last year's number, but improvement, again, over the forecast horizon as that net interest margin firms up. And so in 2025, earnings as a percentage of not overall average assets will be closer to 70 basis points, not quite back up to the long-run norm, but healthier numbers than we'll more than likely see in 2024. Well, that's the story on the economic front and from the perspective of credit union operations for the third quarter of 2024. Please join us again next month for the economic update. We'll discuss other developments related either to the economy or to our work around credit union advocacy. Thanks for joining me. See you next time.